Hey everybody, Joe Joseph here for the Sheeple.com, and this is your news shot. I'm going to go to Yahoo News, who's highlighting a Reuters piece. Could the 1987 stock market crash really happen again? You know, it's kind of one of those questions that people pose saying, well, you know, we've come so far and come so long that it couldn't possibly happen again. They said that about the market in the 1920s, that it was an era of prosperity that would never end, that they would never have the booms and the busts that they had prior to. Why? The Federal Reserve, that was put into place precisely to prevent the booms and the busts. It says here on the 30th anniversary of the 1987 stock market crash, U.S. stocks are at a record high and investors are concerned that steep valuations may mean a correction's overdue despite healthy corporate earnings and economic growth. But could a repeat of Black Monday happen today? Modern trading technology, changes to the way stock exchanges operate and in the way investor funds are managed should make a repeat of 1987 highly unlikely, yet cautious traders refuse to rule it out. Quote, "We've learned a lot from the mistakes of the past in terms of reaction or overreaction," says Ken Polcari, director of the New York Stock Exchange floor division at O'Neill Securities in New York. Now, if you don't remember that day, I remember that day. Monday, October 19th, 1987 it was. That's when the Dow plunged 508 points. Now, today, you may think, wow, that's not a lot of points. Well, back then, that was a 22.6% drop for the biggest ever single-day decline in percentage terms by the blue chip benchmark. A decline of up to 20% in one day, of course, is possible, but it would be likely more an orderly process, according to Art Hogan, chief market strategist at Wunderlich Securities in New York. He says, we have the ability to shut things down for a period of time and reassess and try to ascertain what's the best way to get back in business and take a calmer look at things. Now, in response to the 1987 crash, the U.S. Securities and Exchange Commissions mandated the creation of a market-wide circuit breaker that called a temporary halt to trading after the Dow declines 10, then 20, and 30%. Only one market-wide halt has been triggered since then, and that was in 1997. The circuit breakers were adjusted in 2012, lowering the thresholds needed to trigger a trading pause, with the Dow replaced by the S&P 500 stock index as the benchmark index. So here's the thing about technology and putting all of your confidence in the fact that, why, the government, they have our best interest at heart, and by God, they have put the fail-safes in place to ensure that 1987 will never happen again. Look at 1928, 29, the lead up to the crash, and the crash itself was never supposed to happen. 1987 was never supposed to happen. 2008 was never supposed to happen. But they happened. And the reason why that happened, my friends, had nothing to do with circuit breakers, had nothing to do with safety nets to ensure that a drop didn't happen. It had to do with greed, folks. It had to do with greed from people of power in very high places. In this case, it was Lehman Brothers in 2008. We had the dot-com bubble burst in 2000, 1987. I mean, you can go look back and find these things. They happen all the time. It's cyclical, and you can try to avoid it as much as you can. But until you take humanity out of the loop, then you're going to continue to have these problems. Because if you look at history, it's always been the uber elite, the rich, the ultra wealthy that trigger these booms and busts. What they basically do, here's an example, in the 1920s or before the 1920s, you had to be rich to invest in the stock market. 1920s come along, that prosperity of the roaring 20s was felt down to the grocery store clerk. because a grocery store clerk would, take out a loan and buy stuff in the stock market because it was a surefire thing. Why? It's never going to crash. Everything's going to be okay. So you had blue-collar people, you had low-income people buying into the stock market then. And as soon as all this fresh new money started pouring in, and the value went up, and believe me, there were plenty of warning signs and a lot of people sounding the alarm as they do today. Up. And then J.P. Morgan and his cronies pulls the rug out from underneath and the market crashes. And then, of course, they come in with their capes as the superheroes. Why, we'll lend credit. We'll be there to bail out the market and make sure there's credit available and that the money doesn't freeze up, that the liquidity is there. So they not only caused it, but then they profited from it after they profited from the crash, because it went up. The value went up. They sold high. They crashed the market. They buy low. And then guess what? We'll provide all the credit that's necessary at interest for people to recover. They created the catastrophe. It's Hegelian dialectic. It's classic. So why would anybody be so naive to think that can't happen again? Because, again, it doesn't have to do with technology. It has to do with the human condition. And until we find a solution to greed and the love of money, my friends, this is going to go on and on and on and on. And we're going to have crashes and booms and busts and bulls and bears. Oh, my. I'm Joe Joseph. This was thedailysheeple.com's News Shot. Feel free to comment below and visit our website at thedailysheeple.com. Have a great day, everybody.